and welcome to episode 38 of Mo Money, the investing show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, the host who keeps you the most engrossed, MC Mo. Happy 2017. Sorry for the wait for the new episode, but we are back with an incredibly interesting topic. This week we're talking about interest rates and how they affect the economy and how they affect you. So let's get started. Who am I kidding? Nobody's watching. Done. I'm done. I'm just kidding. But now you kind of feel bad, so I have your attention, even if it's just out of pity. I don't care, because I have something important to share. So we have all heard about interest rates. They're everywhere. There's interest rates on your student loans, on your credit cards, your car payments, your mortgages, pretty much any type of debt that you owe usually accrues some type of interest, and you see them when you pay your bills. But how is that interest rate decided? Well, let's start at the top of the pyramid, which is the U.S. Central Bank, aka the Federal Reserve, aka the Fed. Federal Reserve was created to ensure liquidity to all banks in case of a crisis. So to ensure the safety of people's money, the Federal Reserve was created. Now the Fed has two jobs, or what is called a dual mandate, which is to maximize employment and to control the long-term interest rate. Now the Federal Reserve has two main tools to fulfill their mandate. The first tool is the direct manipulation of interest rates to move the way they want them to. And the second of these tools that the Fed uses is to increase and decrease the money supply. So who exactly are these market manipulators? Well, there is a small group of people at the Federal Reserve called the FOMC, the Federal Open Market Committee. They meet 8 times a year in a secret meeting to discuss interest rates and the money supply. Now, when they meet, it's like, thinking of a good analogy, it's like when they're picking a new pope. You know how everybody stands out there in the middle of St. Peter's Square and holds their breath and waits for the white smoke to signal that there is a new pope? That is what these meetings are like. Leading up to a FOMC meeting, the stock markets can be pretty volatile in anticipation of their decision. Because you can look at all the data on the economy that you want, but at the end of the day, the Federal Reserve has the most control over the economy. So what they say holds a lot of weight. During this time, the financial media and financial Twitter is basically a giant circus. Media outlets will bring pseudo-intellectual econ professors in bow ties to talk about the economy and give their predictions on whether the Fed will raise or keep rates as they are, as well as bank CEOs, hedge fund managers, and everyone and their mothers will come and throw their 2 cents in. At around 2 p.m. on the day of the meeting, the Fed will make an announcement on whether or not they're going to change the Fed funds target rate. The Fed funds target rate is the interest rate that the Federal Reserve is trying to get the banks to lend to each other at. So a lower rate means they want to stimulate the economy, aka grow the economy and increase borrowing. Or if they increase or hike the rate, they want to cool off, or aka slow down the growth of the economy and encourage savings rather than borrowing and spending. After the announcement is made, the chairman or the chair lady of the Federal Reserve, aka Janet Yellen, will come out and make a long speech in her boring, monotone voice about the FOMC decision. It's mostly an hour of vague, rambling, contradictory nonsense that nobody knows how to interpret. I swear to God, it's like she intentionally speaks to bore you to death so you won't want to watch and you won't want to pay attention to what they're doing. That has basically been the MO of the Federal Reserve since day one. Just make themselves so boring that people will have zero interest, no pun intended, in what they are and what they are doing, while they just sit back and enjoy the most power of anyone in the entire world, bar none. Now I know that this is a lot of information to take in, so let me put this into a real life scenario. So remember, we are talking about interest rates and money supply. So let's go back to a time we all remember very well, the early 2000s, George W. era. Interest rates were around 1 to 2% for the beginning of the 2000s. Then the economy started picking up. Things were good, I guess. People were buying homes. The stock market was going up. We were engaged in 2 endless wars. The Kardashians weren't a thing. Times were good. As the economy started picking up, the Federal Reserve quickly started raising interest rates from 1 to 5% in about a year. And they stayed there until about 2008, when the worst financial crisis of most of the world's lifetime struck. Nobody wanted to spend money. Nobody wanted to loan money. And most of the people had no money at all. So what was the Federal Reserve to do in order to jumpstart the economy? They manipulated interest rates. As I explained, interest rates can be like a thermostat that the Fed can control to set the temperature of the economy. So in 2008, the economy and the entire financial structure was cold and on the brink of destruction. So the Fed had to crank up the heat and kickstart the economy. So it did this by cutting interest rates to 0%, a level that has never been seen before in the history of the United States. This essentially meant that for banks to borrow from the Fed or to borrow money from each other, this will cost them 0% interest. And if a bank has excess reserves, meaning more money than it is required of them to have in their reserves, and they wish to store it in the Federal Reserve to accrue interest, they'll earn about 0 to 0.25%, which is not a lot of money. If someone came up to you and was like, hey, you give me $100 and I promise I'll use this to make you a lot more, and you were like,
sure, that sounds awesome.
And they came back and they were like, here's your $100 and 1/4, boom, you'd be like,
that was a total waste. I could totally find a better use for that $100 than that.
Well, that was what the Federal Reserve was hoping. See, instead of parking their money in the Fed or wherever and earning 0%, they wanted banks to loan it out to people because that is the only way that banks would earn money. So by setting the rates at 0, the Federal Reserve was basically saying, loan, loan, loan your funds aggressively up the stream. Merrily, 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 merry. Let's give the economy some steam. So to put it simply, the Federal Reserve manipulated the interest rates to make it incredibly unattractive to save your money. So it was not worth it for banks to save the money that they had. And thus it trickled down to us, normal people. And since it was not attractive for the banks, it was not attractive for us either to save money because the amount of money that we could make while saving our money in the banks was about the same. 0 to 0.25 to 0.5%, maybe 1% if you were lucky. So why do that to people? The Federal Reserve was basically saying, your money is no good sitting in the bank doing nothing. Go out and spend it. Buy things. Buy everything. Buy stuff on credit. Fuck it. Interest rates are 0. Just spend and stimulate the economy. Create demand for things with your spending. Problem is, a lot of banks did not have the money to be spending and loaning, even though interest rates were 0, because they had so much debt and worthless mortgages and bonds. So the Federal Reserve bought all that junk from the banks, the ones that they like, and decided to keep around for cash. And now the banks had all this money to spend and lend to stimulate the economy. And here we are 8 years later. I guess it's anyone's call if it was a success or not, but that is how it went down. Sometimes it works, sometimes it doesn't. You can pump as much money as you want into an economy, and you can manipulate interest rates, but it is much harder to manipulate feelings. You cannot easily make people feel confident about their financial situations, especially after the tough times a lot of people went through during the crisis. Bottom line, the Federal Reserve has a large responsibility, and it is one that can easily be poorly done. The best analogy is, think of the Federal Reserve watering a garden with a hose and trying to make it grow. If they use just enough water, the garden will grow strong and be beautiful. But they're only humans. So what usually happens is they go, water equals good, more water equals really good. So they turn up the hose to the max. The hose goes spraying everywhere, out of control, and the hood is trying to grab it and tackle it to the ground, and they end up completely flooding the garden. This is usually what happens when you try to manipulate things like interest rates, prices, anything like that to your liking. In a free market economy, the banks choose their own interest rates to lend to each other and lend to consumers depending upon their own liquidity. This ensures, if they're smart, the bank will be safe with their money and not loan it out and risk crashing themselves if they're short on capital. But now that responsibility has been handed to an independent pseudo-government agency run by economic professors who obviously know what's best. Thank you so much for watching another episode of Mo Money. For now, don't forget to like, comment, subscribe, and share. Follow us on Twitter. Follow us on Instagram. Like us on Facebook. Be on the lookout for themomoneyshow.com. Until next time,
Mo Money signing out.